We here at iThought are back with two interesting webinars this weekend. The first one is a Hindi webinar conducted by M2W team at 11 a.m. in the morning. Here we are going to talk about the investment strategies and habits that are required to you to achieve your milestone of 1 crore. The second webinar is going to be conducted by a Neo team at 12:30 p.m. noon. This webinar is for NRIs looking to take advantage of the growth story and the opportunity that India offers to the world, where we talk about Neo, a simple and efficient multi-asset investment strategy that can take advantages of various opportunities in India.
Mutual funds unplugged. The Indian mutual fund industry has risen to the occasion in a market which was always paranoid about what will happen if FIIs sell. The mutual fund industry has taken a strong counter position as a stabilizer of the markets. I've always observed that we were craving for such a strong force of stability in our markets. We thought UTI was a stabilizing force in the early 90s. It didn't work that way. We always thought LIC could be that stabilizing force, but somehow LIC has not been able to live up to that expectation. And there are different dynamics which could be connected to its own business cycle. So you needed an independent and stable counter force against the FIIs. And we have long been looking at who can fill that gap, who can take that position and provide stability to the market. The last 5 years have demonstrated very clearly that the Indian mutual fund industry is very capable of being that counter force. So when the markets get overheated, the mutual funds are able to supply, and when the markets collapse or look like they would collapse, the mutual funds come and stabilize the markets. We have all been seeing dips get bought. We have all been seeing shorter corrections. We have all been seeing stronger rallies. The backbone of all these market moves is clearly the Indian mutual fund industry. Even if the PMS industry is doing well or the AIF industry is doing well in India today, I believe it has a lot to do with what the mutual fund industry has achieved. How did it achieve this? It has achieved it by diligently building itself on multiple parameters. The number of accounts, AUM, size of the SIP book, stability of assets, lower churn, extending the duration of ownership in each folio. Everything seems to be happening. And we are also creating multiple mutual funds with size larger than 50,000 crores. The last few years, several asset management companies have crossed that threshold, and I wouldn't be surprised if they all reach 1 lakh crore in the coming years. This stability has been a stellar achievement of the mutual fund industry. But looking at any industry that's doing too well, one should also look for weaker factors. We should identify weaknesses while we celebrate the strengths. And we should work on minimizing the impact of these weaknesses. We should not allow weaknesses to grow. Today I'm going to talk with Subra on the strengths of the mutual fund industry and then the weaknesses of the mutual fund industry, and then hopefully we talk about the industry's response or preparedness and probably what can be done. Subra, over to you. Where do you think the industry is, and do you agree with a few of the things that I have mentioned here?
Yeah, I think so, because unfortunately there are not enough stories of people saying how I use this fund, how I accumulated to achieve my goals. Not enough stories in the market. You only hear negative stories, but wealth has been created for a bunch of people. And so last month, I think for the month of May, we closed at some almost 21,000 crores of SIP book. We have been dreaming of such a big SIP book for a very long time, and now we are achieving it. And month on month, the number is going up. So if 20,900 was the SIP book for the month of, say, May, you can be sure for the month of June it would have been maybe 20,980 or something like 21,500 or something like that. That could be a jump. Of course, this is now amount jump and the valuation jump, both are happening, but yes, people are putting in big amounts of money. It has created wealth for people. It has created an amazing army of fund managers who can tomorrow leave fund A, join fund B or whatever, some of those things. So it's created wealth for people, it has created managers. So having done all this, I do think, and there are what, 45 fund houses. So with all of them functioning, they've created a big army of distributors. So if you ask me, a tremendous amount of good has been done by the mutual fund industry for the people. Yes, there may be downsides, but I would still rate them at something like 90 out of 100, and I wouldn't concentrate too much on the 10 which has not come.
If I were to identify weaknesses in this spectacular phase of achievement, I would think that the money, the composition of the SIP book could have been better. Where the money is going in is something that we are not scrutinizing hard enough. For example, 20,900 is the size of the SIP book. I would think the market should know and all stakeholders should know the composition, the breakup of this, because that will give you a clear dip test of the health of the SIP book. Because when you see that, you can say where SIPs will be stable, where it can become unstable, and where it can actually vanish or where it can stop. Somehow we seem to be unwilling to go granular on this data. That is one aspect where I see a negativity. The second thing again is related to where the money is going. Usually past performance increases the velocity of SIP flows into particular products. Now we are not exactly placing the onus on who should regulate these flows. We are leaving it to the market. And in the market you have two streams of people who are contributing to these flows. One is the investor who is a DIY, who comes direct to the mutual fund. And the other is the advised investor or the investor assisted by a distributor. Now, we don't know whether money going into risky parts of the market through SIP is coming through a distributor or it is coming directly. That is another data point which we don't have. I saw one data point that in small cap, a significant part of the money, close to 40-45%, was going into a single fund, which is a clear risk in my opinion, because with so much of difficulty in deployment, the manager will be left with only one option, that is to move away from the character of the fund, that is invest in large cap companies. That is the only thing he can do. And he is taking in the flows. In my opinion, that is something that is avoidable. When you are not having deployment avenues, you should pause for some time and be true to label rather than take the money and put it in a large cap company. So this is happening because the level of disclosure that is required for investors to make an informed choice on SIPs, on what is the prevailing trend in SIP, seems to be inadequate to the size and stature of the industry today and the kind of impact that the SIP book is already making. When you are making a 20,900 crore impact on the savings book of society, I think the responsibility becomes much higher. And the expectation setting for the future from this set of organizations who are going to grow this book has to be higher. I am not seeing that happening. Any thoughts on this?
So asking a mutual fund which is making a KIM to give you the SIP figure on a fund basis, like they are saying this fund has got 30,000 crore AUM, they can put the SIP figure also.
But it's not in the fact sheet.
No, I'm saying this can be included in the fact sheet, because by including in the fact sheet, you know how much of the, how much new inflow is coming into those funds, and in what is more likely to go into the existing portfolio. If it has got A, B, C, D shares, chances are the fresh money which is coming will also go into A, B, C, D in perhaps more or less the same proportion. So you will know that also. So you will know how this fund man, what this fund manager is planning to do. You can also ask him for a next 3-month view on what he thinks that he is going to do with the fund. Maybe we can ask these questions. But I don't see, even when fund managers are called for interview, they are not asked this question. Nobody asks them, how do you propose to invest the fresh money that is coming to you? Some of it could go to meet redemptions, and some of it could go into the same portfolio.